Before we dive in, let me give you a quick map of where we're going in this module. Module 1 is structured into 6 lessons, each one building on the previous. Lesson 1, what is an option? Is where everything starts. We'll define what an option is, the difference between a call and a put, who the buyer is and who the seller is, and why this contract exists in the first place. Lesson 2, the value of options, takes that foundation and shows you why options are a structurally superior instrument for certain types of trades. We'll look at payoff diagrams, leverage, and what defined risk actually means in practice. Lesson 3, value, moneyness, and expiration, is where pricing gets real. We'll break down how a premium is composed, what intrinsic and time value mean, how moneyness works across IDM, ATM, and OTM options, and why leaps change the game for long-term positions. Lesson 4, delta and gamma, is your introduction to the Greeks. Delta tells you your directional exposure. Gamma tells you how fast that exposure changes. Together, they explain why options behave the way they do when the stock moves. Lesson 5, Theta, Vega, and Rho, covers the remaining 3 Greeks. Theta is the daily cost of holding an option. Vega is your sensitivity to implied volatility. Rho connects long-dated options to interest rate movements, something most beginners overlook entirely. And Lesson 6, Greeks combined plus Black-Scholes, is where it all comes together. You'll read a full live position through the lens of all 5 Greeks, and we'll walk through the Black-Scholes model, implied volatility, and volatility skew. 2 hours. 6 lessons. Everything you need to think and talk about options like a professional. Let's begin.
Let's start with the most fundamental question. What exactly is an option? An option is a contract. But not just any contract, it's a contract that gives you a right, not an obligation. This distinction is everything. When you buy an option, you are paying for the ability to do something, not the commitment to do it. You can always walk away. Specifically, that right is the right to buy or sell an underlying asset, typically 100 shares of stock, at a price that is fixed in advance. That price is called the strike price, and it doesn't change regardless of what the market does. There are 2 types of options. A call gives you the right to buy. A put gives you the right to sell. We'll go deep into both, but for now, remember, call equals right to buy, put equals right to sell. To acquire this right, you pay a price up front called the premium. This is your only cost, and it's also your maximum possible loss. No matter what happens in the market, you cannot lose more than the premium you paid. The downside is capped. The upside is not. Let's make this concrete with an example. Imagine a house worth $300,000. You pay $5,000 for the right to buy that house at $300,000 anytime in the next 3 months. That $5,000 is your premium. Now 2 scenarios. If prices rise and the house is worth $350,000, you exercise your right, buy at $300,000, and immediately have $50,000 in value. Subtract the $5,000 premium, and your profit is $45,000. But if prices fall to $270,000, you simply walk away. You don't buy. You lose only the $5,000 you paid up front. Nothing more. That asymmetry, limited loss, uncapped upside, is the structural advantage of options. And it's the foundation of everything we'll build in this course. Every options contract has 2 parties. Understanding the difference between them is critical, because their experience is completely asymmetric. The buyer, also called the long side, pays the premium up front. In exchange, they acquire the right. They control the decision. And their risk is strictly limited to what they paid, the premium, and nothing more. If things go wrong, they walk away. The seller, also called the short side, is on the other end of that trade. They receive the premium. That money goes directly into their account. But in exchange, they take on an obligation. If the buyer decides to exercise their right, the seller has no choice. They must deliver. This creates a fundamental imbalance in risk. The buyer's maximum loss is fixed and known from day one. The seller's potential loss, especially on call options, can be substantial. In theory, unlimited, because there's no ceiling on how high a stock price can go. Let's make this tangible. Think of a concert ticket with a refund option. You pay $5 extra for a refundable ticket. You have the right to attend or not. The seller of that ticket must honor it if you show up. If the concert is great, you go. If not, you lose only the $5 refund fee. The seller keeps that $5 no matter what, but must be ready to deliver your seat on demand. That's the options market in miniature. Now, and this is important, throughout this course we will be working exclusively on the buyer side. Why? Because as buyers, our risk is defined before we enter the trade. We know exactly what we can lose, and our potential reward remains asymmetric and open-ended. The seller side has its own logic and strategies, but it requires a different risk framework entirely. For now, we stay long. Options didn't start as a speculative instrument. They were invented as a tool for protection, and understanding their origin helps you understand their logic. The earliest forms of options were used by farmers. A wheat farmer doesn't know what price he'll get at harvest, months away. The crop could be wiped out by weather. Prices could collapse. So the farmer buys the right to sell his wheat at today's price, locking in a floor regardless of what happens in the market. That's hedging. That's the original purpose of options. Over decades, this instrument evolved. Wall Street recognized that the same structure, limited risk, asymmetric reward, was extraordinarily powerful for directional speculation as well. In 1973, the Chicago Board Options Exchange, the CBOE, opened as the first regulated options exchange in the world. For the first time, options on stocks were standardized and publicly traded. That changed everything. Today, options exist on virtually every major financial instrument: individual stocks, ETFs, broad indices like the S&P 500, commodities, even interest rates. In this course, we focus specifically on U.S. equity options and LEAPs, long-dated options on stocks and ETFs. Now, let's walk through the wheat farmer example on the right, because it illustrates the hedging logic perfectly. Wheat is trading at $5 per bushel today. The farmer is worried prices could fall by harvest time, so he buys a put option with a strike of $5, paying a premium of 30 cents per bushel. Scenario 1. Harvest comes and wheat has fallen to $3.50. Without the option, the farmer would sell at market and lose $1.50 per bushel. But he exercises his put. He sells at the strike price of $5. After subtracting the 30 cents premium, his effective price is $4.70. He's protected. Scenario 2. Wheat rises to $6.50. The farmer has no reason to exercise. He simply sells at the higher market price. He loses only the 30 cents premium he paid. That's his insurance cost. He still profits. This is the core logic. Pay a small, defined cost up front. Cap your downside. Keep your upside. We'll use this same structure throughout the course, just applied to stocks instead of wheat. We've established what an option is and who the parties are. Now, let's talk about why options are genuinely powerful, not as a marketing pitch, but as a structural fact. When you buy 100 shares of Apple at $200, you have $20,000 sitting in a position that could, in the worst case, go to zero. That's your maximum possible loss, $20,000. It doesn't happen often, but the exposure is there. Every dollar Apple drops costs you $100. Now consider this. You buy a call option on Apple instead. Strike price $210, premium $500. That $500 is everything you can ever lose. Not $501. Exactly $500. The position is defined before you enter the trade. You know your worst case before the market even opens tomorrow. And here's what makes this remarkable. The directional exposure is similar. If Apple goes up, both positions benefit. The option doesn't give you an identical return to owning the stock, but the direction of the trade, the bet you're making, is fundamentally the same. Let's go through the example on the right, because the numbers tell the story better than anything. You have two choices: buy 100 Apple shares at $200, putting $20,000 at risk, or buy one call option at a $500 premium with maximum risk of $500. Apple then rises to $250. The stock position gains $5,000, $50 per share, 100 shares. The option position gains approximately $3,500. Slightly less, yes. But you deployed $500 instead of $20,000. That's 40 times less capital at risk for a comparable directional outcome. This ratio, similar upside, fraction of the downside, is the structural advantage of options. It's not about being reckless or speculative. It's about capital efficiency. You deploy less, you risk less, and you keep more of your capital available for other opportunities. This is the foundation of the coiled spring strategy. We don't use options to gamble. We use them because the structure is simply more efficient than owning stock outright. Before we go further, it's worth understanding where options actually trade, because not all options are the same, and the distinction matters. There are two worlds in the options market. The first is the exchange-traded world, the one we operate in. These are standardized contracts. Every Apple call with a $210 strike expiring the same date is identical, no matter who's on the other side of the trade. They're listed on regulated exchanges like the CBOE, NYSE American, and NASDAQ PHLX. A clearinghouse sits in the middle of every transaction, eliminating counterparty risk. You never have to worry whether the person who sold you the option will actually honor it. The clearinghouse guarantees it. The second world is OTC, over-the-counter. These are private bilateral contracts negotiated directly between two institutions. They can have any terms: custom strike, custom expiry, custom structure. A bank might design an OTC option for a corporate client, hedging a specific currency exposure. Flexible, yes, but also less liquid, less transparent, and carrying counterparty risk. One more important standard to know: in an exchange-traded world, one contract always represents 100 shares of the underlying. Always. This is standardization at its most basic, and it's what makes the market liquid. A market maker in Chicago and a retail trader in Milan are looking at the exact same contract. Now, the example on the right is deliberately different from a stock, and that's the point. Marco has the option to buy an apartment at 300,000 euros within 18 months, and he pays 5,000 euro today for that right. Let's identify the structure. Marco has a call option. The strike is 300,000 euros, the price he can buy at. The premium is 5,000 euros, what he paid for the right. And crucially, he has the right to buy, not the obligation. If the market price of the apartment falls to 250,000 euros, he walks away and loses only his 5,000 euros. If it rises to 380,000 euros, he exercises and captures the upside. This is not a stock option, but the logic is identical. Options don't just live in financial markets. The structure exists everywhere. Once you see it, you can't unsee it. In this course, we work exclusively with exchange-traded U.S. equity options. Standardized, liquid, regulated, with defined risk at every step. We've talked about options in general. Now let's get specific. Let's start with the call, the simplest and most intuitive of the two types. A call option gives you the right to buy an underlying asset at a fixed price. That fixed price is the strike price. You choose when to buy it, as long as it's before the option expires. Let's break down every piece slowly, because every word here matters. When you buy a call, you're essentially saying, I think this asset is going to go up in price. I want to lock in today's price, or a price close to today, so that if I'm right, I can buy it cheap even after it's risen. You pay a premium up front to make that bet. Think of it as your entry fee. If you're wrong, that's all you lose, the premium. Nothing more. Now, when does a call become profitable? The math is straightforward. The underlying asset has to rise above your strike price plus the premium you paid. That total is your break-even point, the exact price at which you start making money. Below break-even, you're in the red. Below the strike, you wouldn't even exercise. Why buy something at $200 if the market price is $180? You just walk away, and you lose the premium you paid. That is your maximum loss. Defined, fixed, known before you even enter the trade. On the upside, there is no ceiling. If the asset keeps climbing, $300, $400, $500, your call keeps gaining value. That's why we say the maximum gain is theoretically unlimited. Let's go through the gold example on the right, step by step. Gold is trading at $2,000 per ounce today. You buy a call option with a strike of $2,000 and pay a premium of $50. Your break-even is $2,000 plus $50, so $2,050. If gold is above $2,050 at expiry, you're profitable. Scenario 1. Gold rises to $2,300. You exercise your right. You buy gold at your strike price of $2,000, even though the market is at $2,300. That's $300 of intrinsic value, the difference between where it is and where you locked in. Subtract the $50 premium you paid, and your net profit is $250. Not bad for a $50 bet. Scenario 2. Gold falls to $1,800. Would you exercise your right to buy gold at $2,000 when you can buy it on the open market for $1,800? No. You let the option expire. You lose the $50 premium. That's it. $50 is the worst this trade can ever get for you. Notice the asymmetry. You risk $50. You can make multiples of that. And you know exactly what you can lose from minute one. That's the call. Thought process. We've covered the call, the right to buy. Now, let's talk about its mirror image, the put. And the put trips up a lot of beginners, so we're going to go slowly. A put option gives you the right to sell an underlying asset at a fixed price, the strike price, before or at expiration. You're not obligated to sell. You have the right to sell. Now, why would you want the right to sell something? 2 reasons. Either you believe the price is going to fall and you want to profit from that move, that's bearish speculation. Or you already own the stock and you want protection if it drops, that's hedging. Think of it as insurance on a position you hold. Let's establish the mechanics. The put is profitable when the underlying price falls below the strike price minus the premium you paid. That's your break-even. If the stock is at $95 and you bought a put at strike $100 for $5, your break-even is $95. Below that, you're making money. Above that, you let the option expire and lose only the premium. What's the maximum gain? If the stock falls all the way to zero, which is extreme but theoretically possible, you can sell at the strike price while the market offers nothing. So your maximum gain is the strike price minus the premium paid. On a $100 strike, put costing $5, that's $95 per share or $9,500 per contract. Now, let's walk through the wheat farmer example on the right because it shows the hedging use of a put perfectly. Wheat is trading at $5 per bushel. The farmer is worried prices could collapse by harvest time, so he buys a put option with a strike of $5, paying a premium of 30 cents. He's buying the right to sell his wheat at $5, no matter what the market does. Scenario 1. Wheat falls to $3.50 at harvest. Without the put, he sells at $3.50 and suffers. With the put, he exercises his right to sell at $5. Subtract the 30 cents premium, and his effective price is $4.70 per bushel, dramatically better than the $3.50 the market is offering. Scenario 2. Wheat rises to $6.50. He doesn't exercise the put. Why would he sell at $5 when he can sell at $6.50 on the open market? He simply lets the option expire. He loses the 30 cents premium. That's his insurance cost, and this time he didn't need the insurance. But he slept well all year, not knowing which way prices would go. That's the put. Protection on the downside, full participation on the upside, at the cost of small premium. The same logic applies whether we're talking about wheat, Apple stock, or the S&P 500. Before we go further, there's a distinction you need to understand that confuses almost every beginner the first time they encounter it. It's the difference between European and American style options, and the first thing to know is that these names have absolutely nothing to do with geography. An American style option can trade in London, and a European style option can trade in New York. The names are purely historical convention. So what's the actual difference? It comes down to when you can exercise the option. A European style option can only be exercised at expiration, not a day before. On the last day, you either exercise or you don't. Examples include SPX and NDX, the big index options. You hold them to the end. An American style option can be exercised at any time, any trading day between now and expiration, including expiration day itself. This is the style you'll encounter on virtually all individual stocks and major ETFs like SPY and QQQ. If you buy a Leaps on Apple, you hold an American style option. Now, here's the critical insight, and this is where most beginners make a mistake. Just because you can exercise early doesn't mean you should. In fact, early exercise is almost never the right move. Why? Because when you exercise an option, you receive only the intrinsic value, what the option is worth if you executed the trade right now at the strike price. But the option also carries time value, the remaining potential built into those months or years of life left on the contract. The moment you exercise, that time value evaporates. You forfeit it. The far better move is to sell the option on the open market. When you sell, the buyer on the other side pays you both intrinsic value and the remaining time value. You capture everything. When you exercise, you capture only part of it. Look at the example on the right. You hold a leaps on Apple American style. You can exercise any day. But if Apple has risen and you want to close the position, selling the contract in the market gives you intrinsic value plus whatever time value is still priced in. Exercising gives you only the intrinsic value. You'd be leaving money on the table. The rule is simple: always sell, don't exercise early. The only rare exception is when an option is so deep in the money and so close to expiration that the time value has been almost entirely eroded. But for leaps, with months of life remaining, you sell. Always. We've talked about what options are and how they work. Now, let's make it concrete with numbers. We're going to look at exactly what happens to a call option at expiration, dollar by dollar, so you can see the payoff structure clearly in your head. And yes, as you'll notice, this slide is the perfect candidate for a payoff chart. We'll add that visual shortly. But for now, let's walk through the numbers and build the picture in your mind first. The scenario is simple. You buy a call option with a strike price of $100 and pay a premium of $5. That $5 per share, $500 per contract, is the maximum you can ever lose. From the moment you buy this option, your worst case is already defined. Let's go through each price level in the example. Stock at $80 at expiration. The stock is well below your strike of $100. You would never exercise the right to buy at $100 when the market offers the stock at $80. The option expires worthless. Your loss is exactly $5, the premium you paid. Nothing more. Stock at $100 at expiration. The stock is exactly at your strike. Exercising gives you the right to buy at $100, the exact same price as the market. No advantage. The option is worth $0 at expiration. Your loss is still $5, the premium. Still the worst case. Stock at $105 at expiration. Now we're above the strike. You can buy at $100 and the market is at $105. That's $5 of intrinsic value. But you paid $5 in premium. So $5 gain minus $5 cost equals $0. This is your break-even point. Exactly strike plus premium. $100 plus $5 equals $105. Below this level you lose money. Above it, you start making money. Stock at $115 at expiration. You exercise, buy at $100, market is at $115. That's $15 of intrinsic value. Subtract the $5 premium, and your net profit is $10 per share, $1,000 per contract. Stock at $150 at expiration. $50 of intrinsic value minus $5 premium equals $45 profit per share, $4,500 per contract. From a $500 initial investment. This is the payoff shape that traders call the hockey stick. From $0 down to the strike, the payoff is flat. You lose exactly the premium no matter how low the stock goes. Then at the strike, the line starts rising linearly. Every dollar the stock rises above break-even puts another dollar in your pocket per share. The asymmetry is what makes this powerful. Your downside is flat and capped. Your upside is a straight line with no ceiling. And this is why we'll add the chart, because seeing that flat line turn into a rising slope at the strike makes the concept immediate and visual. The numbers tell the story, but the shape of the curve tells it faster. Let's stop here for a moment and ask ourselves a fundamental question. Why would anyone use options instead of just buying the stock directly? It's a fair question. And the answer isn't that options are more exciting or more complex. The answer is purely structural. Options give you something that stock ownership simply cannot. A defined loss combined with open-ended upside. Let's break that down. When you buy 100 shares of a stock, your risk is the full value of those shares. If the stock goes to $0, rare but possible, you lose everything you put in. There's no floor. You're exposed to the full downside of the position. When you buy a call option instead, your maximum loss is the premium you paid. Period. No matter what happens, the company goes bankrupt, the market crashes, bad earnings, a scandal. You cannot lose more than that premium. Your floor is set before you enter the trade. And here's the second part. You still control 100 shares. One contract gives you exposure to 100 shares of the underlying, not a partial interest. Full exposure to the price movement of 100 shares for a fraction of the capital. This is what we mean by capital efficiency. Same directional view. dramatically less capital at risk. Now, let's put real numbers on this with Tesla. Tesla is trading at $250. You have two choices. Choice 1, buy the stock. 100 shares at $250 means $25,000 deployed. That's your capital at risk. If Tesla falls 30%, you've lost $7,500. If it goes to zero, you've lost everything. Choice 2, buy call option. Strike $270, premium $800. That's it, $800 is your maximum possible loss. $800, not $25,000. Now Tesla rises to $350. Let's see what happens to both positions. The stock position gained $100 per share on 100 shares. That's $10,000 profit. The call option gained approximately $7,200. Slightly less, yes, because the option was bought slightly out of the money and the premium cost is factored in. So the stock made $10,000 and the option made $7,200. Similar P&L direction. But here's what changes everything. The stock required $25,000 to make that $10,000. The option required $800 to make that $7,200. That's roughly 30 times less capital at risk for a comparable result. And in the downside scenario, Tesla falls instead of rises. The stockholder absorbs the full loss. The option holder loses $800 and nothing more. This is not about speculation. This is not about taking more risk. This is about being structurally smarter with your capital. Knowing your maximum loss before you ever enter the trade. That certainty, that defined risk. When you buy an option and pay the premium, where does that money actually go? What are you paying for? This is one of the most important questions in options education, and most people never stop to ask it. The answer is that the premium you pay is made up of exactly two components, intrinsic value and time value. Understanding both, separately and together, changes how you see every option you'll ever trade. Let's start with intrinsic value. Intrinsic value is the simplest of the two. It's the value the option has right now, today, if you exercised it immediately. If you hold a call with a strike of $180 and the stock is at $200, the intrinsic value is $20 because you could buy at $180 and immediately have something worth $200. That $20 is real, tangible, calculable value. One rule that never changes: intrinsic value is never negative. If an option is out of the money, if exercising it right now would make no sense, the intrinsic value is simply zero. Not negative. Zero. The floor is always zero. Now, let's talk about time value, and this is where it gets interesting. Time value is everything else in the premium beyond intrinsic. It's the price the market puts on two things: uncertainty and remaining potential. As long as there's time left on the option, there's a chance the stock moves in your favor. The market prices that chance. That price is time value. Think of it like insurance. An insurance policy has value not because your house is already on fire, but because there's time, and during that time, things can happen. Same logic here. Time value represents the possibility that the future will be better than the present. Now, let's apply this to the three states of moneyness using the Apple example on the right. Apple is trading at $200. First option, call with strike $180. This is in the money. The strike is already below the current price. It has immediate real value. Intrinsic value is $20. Whatever you paid in premium above $20, that extra amount is time value. You're paying for what's already there, plus the possibility of even more. Second option, call with strike $220. This is out of the money. The strike is $20 above the current price. Apple hasn't reached it yet. If you exercise right now, it would be worthless. Intrinsic value is zero. But the option still has a premium, and every single cent of that premium is time value. You're paying purely for the possibility that Apple moves up more than $20 before expiration. Nothing more, nothing less. What about at the money, a strike exactly at $200? Intrinsic value is zero. Exercising now gives you nothing. But time value is at its maximum. The uncertainty is highest when the stock is right at the strike. It could go either way, and the market prices that uncertainty accordingly. ATM options are the most time value-rich options you can buy. So here's the synthesis, and it's the line that ties this entire slide together. When you buy an option, you are buying time and you are buying potential. You're buying the right to participate in a future move. The intrinsic value tells you what that move is worth today. The The time value tells you what it might be worth tomorrow, next month, or next year. This is why leaps, with 18 or 24 months of time remaining, carry so much time value. And it's why, as that time erodes day by day, the option loses value even when the stock doesn't move. You're watching the clock tick down on the potential you paid for. In the previous slide, we introduced intrinsic value and time value. Now we're going to use those concepts to understand moneyness, one of the most important vocabulary words in options trading. And once you understand it, you'll use it every single day you look at an option chain. Moneyness simply describes the relationship between the current price of the underlying and the strike price of the option. There are 3 states: in the money, at the money, and out of the money. Let's go through each one carefully. ITM, in the money. A call option is in the money when the current stock price is above the strike price. The strike is already favorable. If you exercise right now, you make money immediately. That immediate value is the intrinsic value we discussed. An ITM option has both intrinsic value and time value in its premium. It's the most expensive type of option because you're paying for something that's already working in your favor, plus the potential for further gains. ATM, at the money. A call option is at the money when the stock price is exactly at, or very close to, the strike price. If you exercised right now, you'd break even. Intrinsic value is 0. But here's the interesting part. Time value is at its maximum when an option is at the money. Why? Because the uncertainty is highest right at the strike. The stock could go either direction. The market prices that maximum uncertainty with maximum time value. ATM options are the most time value-rich options available. OTM, out of the money. A call option is out of the money when the stock price is below the strike price. The strike hasn't been reached yet. If you exercised right now, it would be worthless. Intrinsic value is 0. All the premium you pay is pure time value. You're buying the possibility of a future move. OTM options are cheaper, which means they offer higher leverage. A small premium can produce a large percentage return if the stock moves enough. But they also need the stock to travel a meaningful distance before they start generating real value. Now, let's ground all of this in the example on the right. The stock is at $100. Call with strike $90 ITM. The stock is already $10 above the strike. Intrinsic value, $10. Whatever you pay in premium above $10 is time value on top. Call with strike $100 ATM. Strike equals current price. Intrinsic value 0. But maximum time value is priced in. This is the most expensive option on a time value basis. Call with strike $115 OTM. Strike is $15 above the current price. Intrinsic value 0. Small total premium, mostly time value. But for that small premium, if the stock moves $15 or more, the payoff can be significant. That's the leverage of OTM options. Now here's why moneyness matters beyond just describing where we are. Moneyness determines the delta of an option, how much the option price moves per dollar of stock movement. It determines gamma, how quickly that delta changes. It determines the composition of the premium between intrinsic and time value. Moneyness is not just a label. It describes how your option behaves. And this brings us to the coiled spring strategy. We target slightly out of the money leaps with a delta between 0.15 and 0.30. Why slightly OTM and not deep OTM or ATM? Because slightly OTM gives us the best balance. Deep OTM options are cheap but have very low delta and high probability of expiring worthless. ATM options are expensive. We pay a lot of time value. Slightly OTM sits in the sweet spot. Meaningful delta, reasonable premium, significant leverage, and with leaps giving us the time for the thesis to play out. It's not about gambling on a lottery strike. It's about finding the option where the structure is most efficient for the capital we're deploying. Alright, listen carefully because this is one of the concepts that separates traders who make money from traders who wonder where their money went. Every option you buy has an expiration date. And every single day that passes, whether the stock moves or not, whether the market is open or closed, whether it's a Monday or a Sunday, the option loses a little bit of its time value. This erosion is called time decay, and it's measured by a Greek called Theta. We'll cover Theta in depth in Step 5, but right now, I want you to understand the shape of the problem. Because here's what trips everyone up. Most people assume time decay is linear. They think, I have 120 days left, the option costs $10, so I'm losing roughly 8 cents per day. Logical, and completely wrong. Time decay is nonlinear. It accelerates. It's slow and almost polite at the beginning, and then it becomes brutal in the final weeks. The curve looks like a ski slope that starts almost flat and then drops off a cliff near expiration. If you don't understand this, you will watch your positions bleed out in the last 30 days without knowing why. Let me walk you through the example on the right and show you exactly what I mean. You buy an option with 120 days to expiration. You pay $10 for it. Now let's watch what happens every 30 days. From 120 to 90 DTE, the first 30 days. You lose $1. Out of $10 total value, 10% gone in the first quarter of the option's life. Slow manageable. From 90 to 60 DTE, the next 30 days. You lose $1.50. Slightly more than before. The option is now worth $7.50. Starting to feel it, but still under control. From 60 to 30 DTE, the third period. Now you lose $2.50 in just 30 days. A quarter of the original value gone in 1 month. The acceleration is now very noticeable. From 30 to 0 DTE, the final 30 days. You lose $5. Half the original value evaporates in the last month. The same calendar period that cost you $1 at the start now costs $5. The clock is eating your position alive. That's what nonlinear means. Same 30-day window for completely different costs. $1, $1.50, $2.50, $5. Think about what this means in practice. If you're buying short-dated options, monthlies, weeklies, you are constantly in the danger zone. The stock needs to move fast and in the right direction because every day that passes, time decay takes a bigger and bigger bite. Near expiration, an ATM option can lose half its value in a week even if the stock barely moves. OTM options near expiry are even worse. All their premium is time value. When that collapses, there's nothing underneath. You can be right about the direction and still lose everything if the move doesn't come fast enough. This is precisely why long-dated options, leaps with 360 or more days to expiration, behave so differently. When you have 18 or 24 months on the clock, you're sitting on the flat, slow part of that decay curve. You're paying a small, predictable cost per day. Time is not your enemy. It gives your thesis room to play out. One last thing. Time decay doesn't sleep. Weekends count. Holidays count. When you hold a short-dated option over a 3-day weekend, you open Monday morning already down 3 days of decay before the market prints a single tick. Buy time. Respect it. Never fight it. In the last slide, we talk about how time decay accelerates as you approach expiration, how the final 30 days are the most destructive. Now, let me introduce you to the instrument that was specifically designed to solve that problem. LEAPS. LEAPS stands for Long-Term Equity Anticipation Securities. The name is a mouthful, but the concept is simple. LEAPS are options with an expiration date more than 12 months away, typically 18 to 24 months out. They exist on most of the major liquid U.S. stocks, ETFs, and indices. Same structure as any other option. Same mechanics. Just a lot more time on the clock. And that changes everything. Remember the decay curve from the last slide? The part where decay was slow, $1 per 30 days, $1.50 barely moving? That's where LEAPS live. Permanently. For most of their life, LEAPS sit on that flat, early part of the curve where time is not an emergency. I like this analogy. A weekly option is like paying for hourly parking. You need to move fast. You're watching the meter. Every minute costs you something. And if you're not out in time, you get a penalty. A LEAPS is like signing a 2-year lease. You've paid for your space. You're not in a hurry. The car can stay there while you go figure out where you're going. Let's get into the numbers from the example on the right, because this is where it becomes obvious. You're looking at an Apple LEAPS. Strike $220, 18 months to expiration. Delta 0.22, which means for every dollar Apple moves, the option moves roughly 22 cents. Premium is $12 per share, $1,200 per contract. That's your total cost and your maximum loss. Now look at Theta. -3 cents per day. That's 3 cents per share per day, $3 per contract per day. $3. Over a weekend, that's $9. Over a month, roughly $90. It's a cost, yes, but it's a cost you can plan around, budget for, and absorb while you wait for the trade to develop. Now look at the alternative. Same stock, same strike, $220, but a monthly call instead of LEAPS. Theta on that monthly option is -15 cents per day. 15 cents per share, $15 per contract per day. That's 5 times more expensive per day to hold. And you have maybe 30 or 45 days before expiration forces your hand. With the leaps, you have 18 months. Apple can have a bad quarter, go sideways for 3 months, then recover and push through your strike, and you're still in the position. You haven't been forced out by the clock. You had the time to be right. There are 3 structural reasons why experienced traders use leaps. First, slow decay, as we just showed, $3 a day versus $15. Second, high Vega, long-dated options are very sensitive to implied volatility. When 4 expands, leaps benefit significantly even without the stock moving. We'll cover Vega in detail in Step 5. Third, the thesis has room to play out. Markets don't always move in straight lines. They consolidate, they pull back, they digest. With 18 months, you can afford to be early. With 30 days, you can't. The only thing leaps ask from you in return is patience and the discipline to let the position breathe. Every option has a countdown. From the moment you buy it to the moment it expires, every day that passes is 1 day less on the clock. That number, the exact count of calendar days remaining until expiration, is called DTE, days to expiration. It's one of the first things you look at when you open an options chain, and it shapes everything about how the option behaves. Options don't expire on random days. They follow structured cycles, and understanding those cycles is part of basic fluency in this market. Weeklies expire every Friday. They were introduced to give traders more flexibility and tighter control over timing. In practice, they're the most speculative options available. With 7 days or fewer to expiration, Theta is at its most aggressive. The option is losing value by the hour. These are instruments for very short-term, high-conviction directional bets, not for building a thesis, not for patient positioning. If you're wrong by a few days on a weekly, there's no recovery time. The clock runs out. Monthly options expire on the 3rd Friday of each calendar month. These are the most liquid options in the market. Maximum open interest, tightest bid-ask spreads, most active market makers. They're the standard for hedging, for covered calls, for spreads. With 30 to 45 days of life, you have a little more room than weeklies, but Theta is still accelerating meaningfully. You need a move within the month. Leaps are anything beyond 360 days to expiration, typically 18 to 24 months out. As we covered in the previous slide, this is where decay is slow and predictable, and where high Vega makes the position sensitive to volatility expansions. Long-dated options give a thesis the time it needs to develop without the constant pressure of the expiration clock. Now look at the DTE impact box on the right. 3 scenarios, 3 completely different experiences. DTE 400, deep leaps territory. Theta is slow. Implied volatility is the dominant driver. If 4 moves, the position moves. Time is genuinely on your side. You can hold through pullbacks, consolidations, even bad earnings quarters, and still have runway. DTE 30, a monthly option. Theta is now accelerating hard. The stock needs to move this month in the right direction. Every week that passes without a move is a week of compressing value. You're not fighting the market anymore. You're fighting the clock too. DTE 7, a weekly. Extreme decay. The option is burning value by the hour. If the stock doesn't move today or tomorrow, you're in trouble. At this DTE, options behave like lottery tickets. Cheap entry, binary outcome, most of them expire worthless. There are strategies built around this, but they require very specific setups and very high conviction on timing. One practical point worth knowing: when an option's DTE drops below 300, it begins to transition out of true leaps behavior. The decay starts to accelerate meaningfully, Vega sensitivity begins to decrease, and the position starts behaving more like a medium-term option than a long-dated one. This is the moment to start thinking about rolling, closing the position, and opening a new one further out in time, rather than letting the clock run you down. Always know how many days you have left. It's not just a number. It's the environment your trade is living in. Up to this point, we've talked about what options are, how they're priced, and how time affects them. Now, we need to go one level deeper, because to really understand options, you need to understand something fundamental about how they move. There are 2 categories of financial instruments in the world: linear instruments and nonlinear instruments. Options fall into the second category, and that distinction changes everything about how you manage a position. Let's start with linear. A stock is a linear instrument. A futures contract is a linear instrument. The math is straightforward and constant. If Apple moves $1, your position on 100 shares moves exactly $100. Always. up or down, in any market condition at any time of day. $1 move equals $100 gain or loss. That relationship never changes. It's a straight line. Now take an option. A $1 move in Apple does not produce a fixed, predictable change in the option's value. Why? Because an option doesn't depend on just one variable. It depends on multiple variables simultaneously, and each one is moving all the time. Those variables are the price of the underlying moneyness, days to expiration, implied volatility, interest rates, and in some cases dividends. 6 variables, all interacting, all changing, all affecting your option's value at the same time. That's what makes it nonlinear. And this is exactly why the Greeks exist. The Greeks are not academic abstractions. They are practical measurement tools, each one quantifying the sensitivity of your option to one specific variable. Delta measures sensitivity to price. Theta measures sensitivity to time. Vega measures sensitivity to implied volatility. Gamma measures how delta itself changes. Rho measures sensitivity to interest rates. When you understand the Greeks, you understand how your position behaves in any market environment. Without them, you're flying blind. Now look at the analogy on the right, because this is the clearest way I know to show the difference between linear and nonlinear in practice. Stock linear. Apple moves $1. You hold 100 shares. You make $100. Clean, simple, predictable. No other factors. No surprises. Option nonlinear. Apple moves $1. You hold a call with delta 0.35. The option gains 35 cents per share, $35 per contract. But then something else happens. The stock moved, so delta itself has changed. That's gamma at work. The new delta might be 0.37 or 0.38. The next $1 move won't produce the same $35. It'll produce slightly more because the position is accelerating in your favor. But at the same time, implied volatility dropped 2% after the move. Vega takes 20 cents per share away from you, $20 per contract, because the option got cheaper as volatility compressed. And one day passed. Theta charged you 5 cents per share, another $5 per contract gone. So you add it up, plus $1.35 from Delta, minus $20 from Vega, minus $5 from Theta. Net result, approximately plus $1.10 per contract. Not $35. 10. The stock moved in your favor. The option still made money. But the amount it made was shaped by 4 different forces operating simultaneously, and only one of them was the stock price moving up. This is why traders who treat options like stocks, betting purely on direction and ignoring everything else, get confused when the stock moves their way and the option barely responds, or worse, loses value. It's not a mystery. It's Greeks. And once you know them, the mystery disappears. In the previous slide, we established that options are nonlinear, that multiple variables affect the price simultaneously. Now, let me introduce the 5 instruments we use to measure those variables. These are the Greeks. Learn them well because you'll use them every single day you trade options. Delta. Delta measures how much the option's price changes for every $1 move in the underlying stock. A call with delta 0.35 gains 35 cents per share, $35 per contract, for every $1 the stock rises. A put has negative delta. It gains value when the stock falls. Delta is the most intuitive Greek. It tells you the directional exposure of your position. Think of it as, how much of a stock position does this option behave like right now? Gamma. Gamma measures how much delta itself changes as the stock moves. Delta is not static. When the stock rises, the delta of a call increases. When falls, delta decreases. Gamma is the rate of that change, the acceleration. A high gamma means your delta responds quickly and aggressively to price moves. A low gamma means your delta is stable and changes slowly. For buyers, gamma is a friend. It means the position accelerates in your favor as the stock moves your way. Theta. Theta is the daily cost of holding an option. It's the dollar amount the option loses every single day that passes, all else equal. For buyers, theta is always negative. You pay it daily. For sellers, theta is positive. They collect it. We covered this in detail in the time decay slide, but in Greek terms, theta is the number that quantifies exactly how much the clock is costing you each day. Vega new. Vega measures sensitivity to implied volatility. For every 1% change in implied volatility, the option gains or loses the Vega amount per share. A Vega of 0.30 means a 1% floor increase adds 30 cents per share to the option's value, $30 per contract. Vega is why options can gain value when the stock doesn't even move. If volatility expands, the option gets more valuable. Conversely, it's why options can lose value after earnings even when the stock moves in the right direction. The volatility crush after the announcement destroys the Vega component. Rho measures sensitivity to interest rate changes. For every 1% change in the risk-free rate, the option gains or loses the Rho amount. For short-dated options, Rho is almost irrelevant. You can ignore it for practical purposes. For long-dated options, with 18 or 24 months of rate exposure, Rho becomes meaningful. In rising rate environments, call values increase slightly and put values decrease slightly. In falling rate environments, the reverse. Now, the critical point that ties all five together: the Greeks are dynamic. They are not fixed numbers. They change every single day as the stock price moves, as time passes, as volatility shifts, as rates change. The delta you had yesterday is not the delta you have today. You need to monitor them continuously. Let's walk through the example on the right, because this is where it gets real. You hold call option with a delta of 0.35 and a Vega of 0.30. The stock rises $2. Delta gives you plus $0.35 times $2 equals plus $0.70 per share. Good. The stock moved your way. But the rise in the stock also changed your delta. Gamma pushed it from 0.35 to 0.38. The next move will be slightly more profitable. So far, so good. Now, implied volatility drops 3%, common after a stock rises, as uncertainty compresses. Vega takes back 30 cents times 3 equals minus $0.90 per share. That's 90 cents gone because volatility fell, even though the stock moved in your favor. And one day passed. Theta charges you minus $0.05 per share. Final calculation: plus $0.70 minus 90 cents minus 5 cents equals minus $0.25 per share. Negative 25 cents. The stock rose $2 and you lost money on the option. Not because anything went wrong with your directional view, but because Vega worked against you harder than Delta worked for you. This is not a theoretical scenario. This happens constantly, especially around earnings, where 4 spikes before the announcement and then collapses immediately after. You can be right about the direction and still lose if you don't understand the Greeks interacting simultaneously. Know your Greeks. All 5. Every day. Delta is the Greek you look at first every single time you open a position. It's the most intuitive, the most immediately useful, and the one that tells you the single most important thing about your trade. How does this option respond to the stock moving? The definition is precise. Delta is the dollar change in the option's value for every $1 rise in the underlying stock. A delta of 0.35 means the option gains 35 cents per share, $35 per contract, for every $1 the stock rises. Simple, direct, measurable. Now let's understand the two sides. Call options have positive delta, ranging from 0 to plus 1. Positive because calls profit when the stock rises. The higher the delta, the more the option moves with the stock. Put options have negative delta, ranging from minus 1 to 0. Negative because puts profit when the stock falls. A put with delta minus 0.30 gains 30 cents per share for every $1 the stock drops. For the rest of this explanation, I'll focus on calls, but the logic is perfectly mirrored for puts, just flip the direction. Now, here's the part that makes delta genuinely useful in practice. Delta gives you an approximate probability of the option expiring in the money. It's not a precise actuarial calculation, but it's a solid working approximation. A delta of 0.70 means roughly 70% chance of expiring IDM. A delta of 0.20 means roughly 20% chance. This makes delta a quick risk gauge. The lower the delta, the cheaper the option, and the less likely it ends up in the money. Let's map this across the moneyness spectrum. A deep in the money option has a delta approaching 1.0. It's already deep inside profitable territory. For every $1 the stock moves, the option moves almost the same dollar. It behaves almost like owning the stock outright. And at the money option has a delta of approximately 0.50. It's exactly on the fence, equal probability of going either way. A $1 stock move gives you roughly 50 cents per share on the option. A far out of the money option has a delta between 0.05 and 0.15. It's a long way from the strike. Very cheap, very sensitive to direction, very likely to expire worthless. High leverage, but low probability. Now, let's go through the example on the right, because this is where delta becomes concrete. You buy 2 call contracts on Apple. Delta is 0.25. Each contract controls 100 shares, so 2 contracts control 200 shares total. The stock rises $5. Gain equals 0.25 times $5 times 200 shares equals $250. Now here's the way to think about this that most traders find immediately intuitive. A delta of 0.25 on 200 shares means your option position is behaving like you own 50 shares of Apple, not 250. Because 200 times 0.25 equals 50. Your 2 contracts respond to the market as if you held 50 Apple shares. But, and this is the whole point, you didn't pay for 50 Apple shares. You paid the option premium, a fraction of the capital. And your downside is capped at that premium, not at the full value of 50 shares. That's the power of delta understood properly. You're not just measuring how the option moves. You're measuring the equivalent stock exposure your option gives you, and comparing that exposure to what you actually paid, and what you can actually lose. When you build a portfolio of options, you can add up all the deltas across positions to understand your total directional exposure to the market. If your combined delta across all positions is plus 150, you're exposed to price moves as if you own 150 shares of the underlying. If it's plus 20, you have very modest directional exposure. Delta is not just a number on a screen. It's the lens through which you understand what you own.
If delta is the speed of your option, gamma is the acceleration. Let me explain what I mean by that. We established that delta tells you how much the option moves per $1 of stock movement. But delta is not a fixed number. As the stock moves, delta changes. And the rate at which delta changes, per $1 of stock movement, is exactly what gamma measures. Think of it in physics terms. Delta is the velocity of your position. Gamma is the acceleration. When you press the gas pedal in a car, you don't instantly reach 100 kilometers per hour, you accelerate to get there. When a stock moves in your favor, gamma is what causes your option to accelerate, gaining more and more value with each additional dollar of movement. This is enormously important for buyers. When you own an option and the stock moves in your direction, positive gamma means your delta is increasing, which means each successive $1 move is more profitable than the last. The position builds momentum. It accelerates in your favor. Now let's understand where gamma is highest, because it's not uniform across all options. Gamma is highest on 2 conditions: when the option is at the money and when it's near expiration. Why? Because ATM options sit exactly on the fence between profitable and not profitable. A small move can push them decisively one way or the other, causing a rapid shift in delta. Near expiration, the same dynamic intensifies. Small moves cause dramatic changes in probability and therefore in delta. This is important to know because it works in both directions. High gamma near expiry means huge potential gains if the stock moves your way, but also huge potential losses if it moves against you. It's a double-edged sword. For long-dated options, leaps, gamma is naturally low. The delta changes slowly and predictably. A $5 move in the stock shifts delta by a modest amount. This makes leaps easier to manage. The position doesn't lurch around dramatically with every tick. You know approximately what your exposure is tomorrow, next week, next month. That stability is a feature, not a limitation. Now let's walk through the example on the right, because the numbers make this crystal clear. You hold a call with a delta of 0.40 and a gamma of 0.03. The stock rises $5. What happens to your delta? New delta equals 0.40 plus 0.03 by 5 equals 0.55. Your delta went from 0.40 to 0.55 because of that $5 move. You started with an option that behaved like owning 40 shares. Now it behaves like owning 55 shares, without you doing anything. The stock rises another $5. New delta equals 0.55 plus 0.03 by 5 equals 0.70. Now you're at delta 0.70. From 0.40 to 0.70 in a $10 stock move. The position didn't just move, it accelerated. Each $5 move delivered more value than the previous one. This is what traders call convexity. The payoff curve is not a straight line, it's a curve that bends in your favor. The more the stock moves in your direction, the faster your position grows. The more it moves against you, the slower it shrinks. because delta is falling on the downside too, reducing your losses per dollar. For buyers, convexity is one of the most powerful structural advantages of owning options. You get more of the upside and less of the downside, not because the math is magic, but because gamma is reshaping your exposure dynamically as the market moves. Understand convexity and you understand why serious traders pay premium to own options rather than just stock.
Every time you buy an option, you're making a deal with the market. And like all deals, it has two sides. You get something and you give something up. Understanding this trade-off is not optional. It's fundamental to understanding why options behave the way they do. Here's the deal. When you buy an option, you get positive gamma and you pay negative theta. Positive gamma means your position accelerates in your favor when the stock moves your way, as we covered in the previous slide. The position builds momentum. Convexity works for you. Negative theta means you pay for that privilege every single day. Time passes, value erodes. The clock is always running. These two Greeks are permanently linked. You cannot have one without the other. You cannot own positive gamma without paying theta. You cannot collect theta without accepting negative gamma. It's not a market inefficiency. It's not a loophole you can find your way around. It is the structure of the instrument. Now flip to the other side. When you sell an option, the deal reverses entirely. You collect positive theta, the daily decay works in your favor, you are the one receiving the time value as it erodes. But you carry negative gamma, when the stock makes a large move, it hurts you. Your delta shifts against you. The bigger the move, the bigger the damage. Neither side is objectively better. They're different games with different risk profiles, different time horizons, and different sources of edge. Let's look at the two extremes in the trade-off box on the right. The leaps buyer. You buy a long-dated option. Gamma is low. The position doesn't lurch with every tick. Delta changes slowly and predictably. Theta is also low, perhaps $3 per day per contract. You're paying $3 a day to hold a position that gives you exposure to 100 shares of stock with capped downside. $3. You can hold this for weeks through a sideways market, through a pullback, through a consolidation, without the position bleeding out. Time is genuinely on your side. You need the stock to move eventually, but not today, and not this week. The weekly option seller. Completely different game. You sell a short-dated option and collect perhaps $80 per day in theta. That sounds attractive. And it is when nothing happens. The problem is gamma. When stock gaps up or down overnight, or makes a sustained directional move, the seller's delta shifts dramatically. A 0.10 change in delta on a short option position means the exposure to the underlying has changed significantly, and not in the seller's favor. One unexpected earnings pre-announcement, one macro event, one gap at the open, and the entire week's theta income is gone. Sometimes worse. These are not just different strategies. They are different philosophies about risk. The buyer pays daily to be protected from large moves and to benefit from them. The seller earns daily and accepts the risk of large moves working against them. Neither is right or wrong in absolute terms. But you need to know which game you're playing before you put the trade on, because confusing the two is one of the most common and expensive mistakes new traders make. When you buy, know what you're paying and why. When you sell, know what you're collecting and what you're absorbing in exchange. The gamma-theta trade-off is always there. It never disappears. The only question is which side of it you're on. We've talked about theta in the context of time decay. Now let's get precise about it, because theta is not just a concept, it's a number you need to know for every position you hold. It's the answer to a very specific question. How much is this position costing me today just by existing? The definition is exact. Theta is the daily dollar loss in an option's value from the passage of one day, with everything else remaining unchanged. Stock price the same, volatility the same, rates the same. Just one day passes. That's what theta measures. It's expressed per share. And since one contract controls 100 shares, you always multiply the per share theta by 100, and then by the number of contracts you hold, to know your actual daily cost. For buyers, theta is always negative. You are on the paying side of time. Every day you hold the option, a small amount of value leaves the position. It doesn't ask for permission. It doesn't wait for you to be ready. It just happens. For sellers, theta is positive. They're on the receiving side. Every day that passes puts money in their pocket, as long as the stock doesn't move against them significantly. Now, let's make this concrete with the example on the right, because this is where traders really feel theta. You hold 5 contracts on a short to medium-dated option. Theta is minus $0.06 per share per day. Simple enough. But let's calculate the real cost. 5 contracts times 100 shares equals 500 shares of exposure. 6 cents times 500 equals $30 per day. Every single day, $30 leaves your position, just from time passing. That's manageable on a Tuesday. But now think about a long weekend, Friday close to Monday open. 3 calendar days pass. 3 days of Theta. $30 times 3 equals $90 gone before the market even opens on Monday. You sit down at your desk, open your positions, and you're already down $90 before the first tick. Now compare that to a long-dated option, same number of contracts, same stock, but with a Theta of only minus $0.02 per share per day. 2 cents times 500 equals $10 per day. Same 3-day weekend costs you $30 instead of $90. 3 times cheaper to hold. Over a month, the short-dated position costs you roughly $900 in Theta. The long-dated position costs $300. Over 6 months, the difference compounds into thousands of dollars, and the long-dated option still has plenty of life left on it. This is not a trivial difference. When you're managing multiple positions simultaneously, the cumulative Theta across your entire portfolio becomes a significant number. Knowing it precisely, knowing that your book is costing you $X per day in time decay, tells you exactly how much the market needs to move to break even, and how long you can afford to wait before the cost of holding outweighs the potential gain. There is one more thing worth repeating because it trips up even experienced traders. Theta does not pause on weekends. The option market is closed Saturday and Sunday, but time does not stop. The decay that accumulates over the weekend hits all at once when the market opens Monday morning. If you're carrying a position over a 3-day weekend in a short-dated option, you are accepting 3 days of time decay with zero ability to respond to any news that breaks over those days. Know your Theta. Know it per day, per week, per contract. It's the rent you pay for being long an option. As most people who come from a stock trading background. With stocks, value moves when the price moves. With options, value can move significantly even when the stock doesn't move at all. Vega is the reason why. Vega measures the dollar change in an option's value for every 1% change in implied volatility. A Vega of 0.28 means that for every 1 percentage point increase in implied volatility, the option gains 28 cents per share, $28 per contract. And for every 1 percentage point decrease, it loses that same amount. Vega works in both directions. But before we go further, we need to understand what implied volatility actually is, because Vega is meaningless without it. Implied volatility is the market's expectation of how much a stock will move in the future. It's derived from option prices themselves. If options are expensive, implied volatility is high. If they're cheap, it's low. When uncertainty is high, before earnings, before major economic announcements, during market crises, implied volatility spikes. When calm returns, it compresses. It mean reverts. It tends to come back down after expanding. This creates a fundamental opportunity. If you buy options when implied volatility is low, you're buying cheap Vega. You're paying less for the uncertainty embedded in the contract. When volatility subsequently expands, as it tends to do, the value of your option increases, even without any movement in the stock price. This is called a volatility pop, and it's one of the most powerful and underappreciated mechanics in options trading. Now, why do leaps carry high Vega? Because Vega scales with time. The more time remaining on an option, the more uncertainty is priced into it, and the more sensitive that option is to changes in implied volatility. A 30-day option has relatively low Vega. An 18-month leaps has very high Vega, which means volatility expansions have a much larger dollar impact on the position. Practically speaking, this means when you buy long-dated options and volatility is depressed, you are in a structurally favorable position. You own high Vega at a low price. When the market eventually becomes more uncertain, and it always does at some point, your options benefit significantly. You don't need to be right on timing the stock move. You need the market's perception of risk to increase. A useful discipline when buying options: check where implied volatility is relative to its historical range before you buy. If 4 is historically elevated, you are buying expensive Vega. You're paying top dollar for uncertainty that may compress and work against you. If 4 is historically compressed, you're buying cheap Vega, and the odds of it expanding rather than compressing further are in your favor. Now, let's walk through the example on the right, because the numbers make this undeniable. You hold call option with a Vega of 0.28. The stock's implied volatility today is 22%. Something happens in the market, a macro announcement, a sector rotation, broader uncertainty. Implied volatility rises from 22% to 30%. That's an 8 percentage point increase. Your gain per share, 0.28 times 8 is equal to $2.24. Per contract, 100 shares, $224. The stock did not move. Not a single dollar. The company didn't report earnings. No news came out specific to that stock. Pure volatility expansion, and your option gained $224 per contract. Now think about what that means at scale. If you hold 5 contracts, that's $1,120 in profit from a volatility move, with the stock flat. If you hold 10 contracts, $2,240. Without the underlying moving a tick. This is not a theoretical edge. It's structural. And it works in reverse too, which is the risk. If you buy options when 4 is already elevated and it subsequently compresses, Vega works against you. The stock can move in your direction, and you can still lose money because the volatility crush takes away more than delta adds. Timing your entries around implied volatility levels is not optional. It's part of the discipline of trading options correctly. Rho is the Greek nobody talks about at the trading desk until they get caught by it. And then they talk about a lot. Let's be honest up front, for most options, most of the time, Rho is almost irrelevant. If you're trading weekly options, monthly options, even 90-day options, Rho is a rounding error. You can functionally ignore it, and your P&L will barely notice. The sensitivity to interest rates over a short time horizon is simply too small to matter in practice. But the moment you move to leaps, 18 months, 24 months, Rho deserves attention. Because over that kind of time horizon, interest rates have room to move significantly, and the cumulative effect on your position is real and measurable. The definition first, Rho is the dollar change in an option's value for every 1% change in the risk-free interest rate. A Rho of 0.12 means that if the risk-free rate rises by 1 percentage point, the call option gains 12 cents per share, $12 per contract. Now, why does this relationship exist? To understand it intuitively, think about what a call option gives you. It gives you the right to buy a stock at a fixed price in the future. In a world of higher interest rates, the present value of that future obligation is worth less, meaning the stock price you'd pay at exercise is effectively cheaper in today's dollars. That makes the call slightly more valuable. Conversely, a put gives you the right to sell at a fixed price. Higher rates reduce the present value of that future inflow, making the put slightly less valuable. The direction is simple to remember. Rising rates help call buyers, hurt put buyers. Falling rates do the opposite. Now let's look at why this actually mattered in the real world, because 2022 and 2023 gave us a live case study that most options traders didn't fully account for. At the start of 2022, the Federal Reserve's benchmark rate was effectively 0. By mid-2023, after one of the most aggressive hiking cycles in decades, it had reached 5.5%. A 5.5 percentage point move in less than 2 years. If you were holding leaps calls during that period, 18 to 24 months out, Rho was silently working in your favor the entire time. Not dramatically on any given day. Not visible in the daily P&L in a way that stood out. But cumulatively, meaningfully present. Let's run the numbers from the example on the right. You hold a leaps call with a Rho of 0.12. The Fed hikes rates by 1%. Your option gains 12 cents per share, $12 per contract. Quietly, without the stock moving. Now imagine the full hiking cycle, a 4% rise in rates over 18 months. Rho contributed approximately $48 per contract to your position over that period. $48 per contract from interest rates alone. If you held 10 contracts, that's $480 of P&L that had nothing to do with the stock price moving. Invisible day to day, but very real when you add it up over a full rate cycle. And for leaps puts held during the same period, the effect was reversed. Rising rates worked against those positions, $48 per contract quietly eroding value, while the traders who held them may not have fully understood why the position underperformed their directional thesis. The lesson is practical. When you enter a leaps position, form a view on the interest rate environment. You don't need to be a macroeconomist. You just need to know whether rates are likely to rise, fall, or stay flat over the life of your option, and factor Rho into your position sizing and expectations accordingly. It's the quietest Greek, but in the right environment, it's far from insignificant.
We have reached the end of this first module, and it is worth taking a moment to look back, not to celebrate but to consolidate. Because what you have just absorbed in this course is not trivial. Let's start with the fundamentals. You now understand what options are: financial instruments that give rights, not obligations. You understand the fundamental difference between the buyer and the seller. The buyer pays a premium to obtain a right, while the seller receives that premium in exchange for taking on an obligation. You have learned the 4 basic positions: long call, long put, and short put, and for each one you now know the risk profile, the payoff at expiration, and the economic logic behind it. You understand the difference between exchange-traded options and OTC options, between European-style and American-style options. These are not details, they are the foundations. Without them, you cannot properly reason about anything that comes next. Then we moved on to the structure of price. You learned that an option premium is not a random number, it is the sum of 2 precise components: intrinsic value, which is the real and immediate value of the option, and time value, which is everything else, the time remaining, volatility, expectations. You learned what moneyness means, IDM, ATM, OTM, and why that distinction changes everything in the behavior of an option. You understood time decay, and more importantly, you understood that it is not linear, it is not a constant drop day after day but a curve that accelerates during the final 30 days. And you understood why leaps, long-term options, change the rules of the game. They give you time, slow down decay, and allow you to build directional theses without the pressure of the calendar. And then we arrived at the part that many new traders ignore until it blows up in their hands: the Greeks. You learned all 5 of them. Delta, your directional exposure, how many dollars you gain or lose for every dollar of movement in the underlying. Gamma, how your delta changes over time, the acceleration of the position when the market moves in your favor. The trade-off between gamma and theta, you cannot have every advantage without paying something. The more convexity you buy, the more time costs you. Theta, the daily cost of keeping the position alive, and you saw with numbers why leaps make this much more manageable. Vega, sensitivity to implied volatility, and you understood why entering when 4 is compressed is the most efficient way to buy Vega. And finally, Rho, invisible in the short term, but real and measurable on long-dated positions, as demonstrated by the Fed rate hiking cycle between 2022 and 2023. This is Module 1. It is not abstract theory, it is the operational vocabulary of anyone who works with options. Every single concept we have covered will serve you every time you look at an options chain, every time you evaluate an entry, every time you manage an open position. In Module 2 we will go deep into volatility, historical versus implied volatility for rank and 4 percentile in real-world practice, the phenomenon of volatility crush, the volatility surface, and skew. That is where great traders separate good entries from mediocre ones, and you will be ready for it.